Something doesn't make sense in Dubai anymore. From the outside, it still looks like the same city. Glass towers glowing at sunset, private villas lined with palm trees, luxury cars parked outside homes that look like they belong in a movie. Everything still feels expensive. Everything still feels elite. But then you hear something that doesn't fit that image. A mansion listed at 30 million dirhams in 2022 quietly reappears months later at 22 million, then 18, then disappears from listings entirely. Another villa sits empty for a year, then sells off-market at a lower price. Not loudly, not publicly, quietly, almost hidden. And that's the part that matters. Because luxury markets don't usually drop first. They are supposed to be the strongest, the most protected. So if even that layer is starting to weaken, then something deeper is shifting underneath the surface. And once you understand what is driving that shift, the story becomes much bigger than just a few discounted mansions. For more than a decade, Dubai sold one of the strongest financial narratives in the world. Not just lifestyle, but certainty. The idea that real estate, especially high-end property, would always hold value and most likely grow. Between 2012 and 2019, prime areas like Palm Jumeirah, Downtown, and Emirates Hills saw steady appreciation. In certain years, price growth in luxury segments reached 8% to 12%. After the global slowdown of 2020, the market came back even stronger. By 2022, demand surged again, driven by global uncertainty. Wealthy investors moved capital into Dubai because it felt stable, tax-efficient, and fast-moving. Russian buyers after sanctions, European investors facing inflation, and South Asian capital looking for security all entered the market. In 2023 alone, Dubai recorded over 122,000 real estate transactions, one of the highest in its history. At that moment, it didn't feel like a cycle. It felt like a permanent trend. But underneath that growth, the structure was always different from traditional markets. Dubai's luxury property market is not built on local income levels. It is built on global capital flows. That means demand does not come from people earning salaries inside the city. It comes from investors moving money across borders. And that type of demand is powerful but unstable. It reacts quickly to global events. When money flows in, prices rise fast. But when that flow slows, even slightly, the effect is immediate. And that's exactly what started happening after late 2023. The inflow of foreign capital didn't stop, but it became more selective. Buyers became more cautious, deals took longer, and that small change was enough to shift the momentum. At the same time, supply kept growing. According to market projections, Dubai is expected to deliver over 300,000 new residential units between 2024 and 2027. A portion of these are luxury villas, branded residences, and waterfront developments. This creates a supply pressure that didn't exist during earlier growth cycles, because now buyers have more options than ever before. In some villa communities, inventory increased by over 20% within a year, and when supply grows faster than demand, prices don't crash immediately, but they soften. Sellers begin adjusting expectations. Listings stay active longer. Negotiations become more flexible. And over time, actual transaction prices begin to move lower than advertised prices. Holding costs are another major factor that is often ignored. Owning a luxury property in Dubai comes with ongoing expenses. Annual service charges can range from 15 to 30 dirhams per square foot depending on the location. For a large villa, that can mean 40,000 to 100,000 dirhams per year just in maintenance and services. Add cooling costs, landscaping, and property management, and the total annual cost can increase significantly. If the property is not rented, that cost becomes a direct loss. And in the luxury segment, rental demand is limited compared to supply. High-end tenants are fewer, and many prefer short-term stays rather than long-term commitments. So investors who expected rental income often find themselves carrying the full cost. Another layer is the rental yield reality. While Dubai often advertises yields of 6% to 8%, in the luxury segment, the actual yield is usually lower. In many high-end villa communities, net rental yields can fall to 3% to 4% after expenses. That's lower than what investors can achieve in other global markets with less risk. And when investors start comparing returns, they adjust their strategy. Some hold for long-term appreciation, others exit. And when enough investors choose to exit, supply increases further. There is also a shift happening in buyer psychology. In 2021 and 2022, buyers moved quickly. Fear of missing out drove decisions. Properties sold within days, but by 2024 and into 2025, that urgency has slowed. Buyers take more time. They negotiate harder. They wait for better deals. This changes the entire market dynamic, because when buyers are patient and sellers are under pressure, prices adjust, not in headlines, but in real transactions. At the same time, global competition is increasing. Saudi Arabia has launched large-scale projects like Neom and Vision 2030, aiming to attract the same high-net-worth individuals and professionals. Riyadh is offering competitive salaries, tax advantages, and government-backed incentives. European destinations like Portugal and Greece offer residency programs with lower property costs and easier long-term settlement options. Even cities like Singapore and London, despite higher taxes, offer stability and established financial systems. This means Dubai is no longer the only choice for global investors. And it is one option among many. Climate also plays a subtle but important role. Dubai's extreme heat, especially between June and September, limits how properties are used. Outdoor spaces, which are a major part of luxury living, become less practical during these months. While indoor infrastructure compensates for this, it changes the overall experience. For investors comparing global luxury markets, climate becomes part of the decision. It may not be the main factor, but it contributes to the overall evaluation. The human impact of this shift is more subtle, but just as important. Real estate agents who once closed deals quickly now face longer sales cycles. Developers slow down new launches. Investors who expected easy returns are forced to rethink their strategy. Some hold, some sell at lower prices. And the perception of the market begins to change. Because luxury markets depend heavily on perception, the idea that prices will always rise. Once that idea weakens, behavior changes. Another important point is that Dubai's market is highly sentiment-driven. Perception plays a huge role. When the market is rising, confidence attracts more buyers. But when the market slows, even slightly, that confidence can weaken. News of price adjustments, even if limited, spreads quickly among investor communities. And once sentiment changes, behavior follows. Buyers wait, sellers adjust, and the cycle shifts. This doesn't mean Dubai is collapsing, far from it. The city still has strong infrastructure, strategic location, and global connectivity. It remains one of the most active real estate markets in the world. But what is changing is the nature of growth. It is no longer driven by rapid, aggressive expansion. It is becoming more selective, more balanced, and in that transition, certain segments, especially luxury, feel the adjustment first. There are deeper layers behind this as well. Cost of living in Dubai has increased significantly. While this affects mid-level residents more directly, it also influences the overall market, because a strong property market needs a strong population base. If fewer people can afford to live in the city comfortably, demand at all levels is affected. Climate is another factor. Extreme heat limits outdoor living for large parts of the year. This affects how properties are used and perceived. Global competition is increasing. Cities like Riyadh, Singapore, Amr and Lisbon are attracting investors with different advantages. Lower costs, better climate, more stability in some cases. Because in most markets, the top moves first. Luxury is where prices rise fastest during growth, and where they adjust first during slowdowns. It acts as an early signal. Not a collapse, but a correction. And corrections are part of any market cycle. So when you hear that a luxury mansion in Dubai sold for less than expected, it's not just a deal, it's information. It tells you that the system is changing, that demand is becoming more cautious, that supply is increasing, and that the balance is shifting. And that leads to a bigger question. If the strongest part of the market is adjusting, what does that mean for everything else? Because markets don't stay the same forever. They evolve, they correct, they reset. So, what do you think? Is this just a normal adjustment in a fast-moving market? or the early stage of a larger shift? Would you invest in Dubai real estate today, or would you wait? Let me know your thoughts in the comments. And if you want more clear, simple, and real breakdowns like this, make sure to like and subscribe. Because sometimes the biggest changes don't make noise. They happen quietly, and by the time you notice them, they've already begun.